Yo, what's up guys? My name is Tito Durojaye and I'm a stock and options trader. And today in this video, I will be telling you guys the options trading basics and what calls and puts are. If you have never heard of options trading, essentially I'm going to explain it. So let's start with what is an option. Essentially, an option is an obligation to 100 shares of a stock in a contract. So they give you basically when you buy this contract, say you buy a contract for $200, you're either doing one of two things. Well, there's more than two, but the basic two are up and down. So call is up, put is down. So say that you buy a contract for $200 and that contract suddenly becomes more worth and you're like, okay, now I want to sell it at $300. Now you pocket that $100 that you just sold it for. So basically you sell it for the difference. Same in the loss category. So if you were to sell it for $100, you would just basically take that difference in a loss. The easiest way to imagine stock options, in my opinion, is to look at it like a sentence. So say that we choose Apple stock. We all know Apple stock. They make the iPhone, the MacBook, the iPad, lots of things. So basically, say you want to trade this stock and you think that Apple will go up in the next day or so. So what you would do is basically you would buy a call option, which means you think that Apple's going to go up. Say that Apple's at 140 and you want it to go to 141. Now, you can buy a 145 call. It doesn't actually have to reach 145. It just has to go up in a certain amount of time. So if you buy a call, then you're saying that Apple is going to reach 145 by so-and-so's date. Say that you choose 2 weeks from now. So now that you put in a sentence, it helps you visualize it more. So say that Apple is at 140 and it goes to 141. Now it's easier to see that sentence come true. Apple is going to hit 145 2 weeks from now, but it's already gone up $1 in one day, less than 1 day. So you would begin to profit on that contract because that sentence is looking true. It's probably the easiest way to visualize it, in my opinion. If it doesn't help you, comment down below and I'll think of more things to visualize it. But essentially, it's the same for the downside. If Apple starts to drop and Apple goes to 139 instead of 141, but you have that same 145 call, now that sentence is looking less believable. Apple will go to 145 in 2 weeks, but it just dropped to 139. So I don't think Apple's going to go to 145 in 2 weeks. So therefore, you would lose money on that contract until Apple starts going back up. So that's another thing. Expiration. So the closer the expiration, the less time the sentence has to come true. So if you have a 3-day expiration, so you buy a contract and it expires in 3 days, automatically you're going to lose money if it starts to drop because you literally have no time for it to become a correct sentence. Unless you exactly know what it's going to do, which a lot of traders take use of. They take use of short term because short term gives you more profits, but long term gives you more safety, essentially. So if you buy this call option and it expires in 3 days and it starts to go up, you'll profit more. But if it starts to go down, you'll lose more than you would if the expiration was 2 weeks. Now that we've talked about both calls and puts, essentially, what should you look for on each one of these? Again, call option means you want it to go up. Put option means you want it to go down. But on each contract, they have a delta, theta, and a vega. So delta is how much you'll make per dollar move on each stock. So essentially, say you buy that same Apple 145 call and you're like, okay, it moved $1. So say your delta is 0.56. You would multiply that by 2 decimal places and that would be how much money you would make per dollar move on each contract. So say you bought this Apple contract for $200. Now that your delta is 56, that contract is now $256 and you can pocket the $56 difference because your delta is 56. If it moved $2, multiply that by 2, $3, so and so and so and so. So that's how you can calculate how much you would make on a contract per dollar move. So it's really a useful indicator just to see how much options would move. Now going on to theta, it's called time decay. Basically, theta means time decay because this is automatically how much you're losing every single day on a contract, no matter if you just didn't move at all. So say Apple just stayed in place, you would automatically lose say, if it's 0.07, you would lose $7 per day just if Apple didn't move at all. But that's why people get in and get out of these options very quick, because you don't want to run into time decay and you don't want time to get the best of you. And vega is the last one, and it's volatility. So this is how much volatility each contract has. It varies on each contract, but basically it'll change your delta as well. Vega is just good to watch out for because it'll tell you how much volatility is on a contract. There are short-term and long-term options. So, but basically, the basic two you're going to look for is calls and puts. The best brokers I think to do this on is Webull and Thinkorswim. Webull is probably the best if you're just an intermediate/beginner. Robinhood only if you have a cash account, which I will talk about in another video. But Robinhood is pretty bad. But I would do Webull because, in my opinion, it's the best crossover between like good enough but not too hard to understand if you really put your mind towards it. But that's options trading for beginners. I hope this helped, and if you guys have any more questions, leave them down below and give this video a like and thumbs up. Thank you guys so much for watching. I'll see you guys later.